Well, hello, my name is Mark Ruff, and today's short video is what is the nature of a cap rate? What is a cap rate, and why is it important in real estate? And in order to do that, we need to briefly chat about the three ways to determine value in real estate. So let's dive right in. There are three ways essentially to determine value in real estate. There's the comparable sales approach, which is essentially reserved for single-family residences, condominiums, townhomes, and typically 2 to 4 unit properties. These are kind of smaller investment properties, as well as vacant land. And the metric that we use is essentially dollar per square foot of improvement. Now, in the case of vacant land, there is no improvement, so we would just look at the dollar per square foot of the land. Okay. The second approach is the cost approach, and that is typically reserved for institutional grade real estate, for example, hospitals, government buildings, museums, and the like. And that metric that is used is the dollar per square foot. All right. The third and final approach, and that's the one we're going to take a look at today as it relates to cap rate, is the income approach to value. And this is reserved for apartment properties that consist of 5 or more units. Recall that the 2 to 4 unit properties, we use the comparable sales approach. But for in place of 5 units or more, we use the income approach. And that's usually because of the financing scenario that I'll reserve for a later presentation. All right. But the income approach is reserved for 5 or greater unit properties, existing retail, office, and other commercial property types. And the metric that we use to determine value using the income approach is the capitalization rate. It's typically abbreviated as a capital R or a small k. When I was in the USC Master of Real Estate Development program, you learned to use the small k to abbreviate the cap rate. And so that's what I'll use today. All right, let's continue. Let's take a look at a hypothetical example of a 10-unit apartment property that is on the market for $3.5 million. All right, so it's a very simple approach to a 10-unit apartment property, and I've recreated kind of a plain vanilla scenario to illustrate the concept of a cap rate. So what I teach my students is, think of a cap rate as essentially this. A cap rate could be viewed as an unleveraged return, meaning that if I were to write a check for $3.5 million for this 10-unit apartment property, at the end of the year, it's going to have some net operating income. All right. At the end of the year, this $3.5 million, I'll have a 4.56 cap rate. And let's take a look at this. Whenever we look at an investment property to purchase or to sell, we have to start with some basic data. All right. Now we're going to look at this from an acquisitions perspective. Okay. So at the end of the year, at the beginning, I'm going to look at buying this property for $3.5 million. It's 10 units, and each unit is rented at $2,000 per month. All right. So when we're looking at purchasing a property, we have to start by accumulating some data. And what I teach my students is, with that data, we're going to reconstruct an operating statement. Okay. If I were to buy this property for $3.5 million, how much then can I rent each of these 10-unit properties for at market rents? So we're always going to start with market rent. Now, does that mean that all of these apartment properties are going to be presently leased or rented at market rent? Maybe not. But we're going to look at it from the perspective of market rents. So for 10 units, each unit is going to be rented at $2,000. At the end of the year, my gross potential rent is going to be $240,000. And that's calculated by taking 10 units times $2,000 per month, multiplied by 12 months, right, for the year. That's a gross potential rent of $240,000. Now, the second data point that we're going to take a look at is there's likely going to accrue some vacancy, meaning that maybe during the course of a year, some units might turn. They might become vacant. Maybe a tenant decides to move to another part of town. Maybe there's a job transfer to another city or another part of town. Maybe the tenant might want to downsize. There's a lot of downsizing occurring right now. Or maybe during the course of the year, a tenant either cannot or chooses not to pay rent for some reason. There might be some credit losses. But for the sake of argument, we're going to impute a 5% vacancy rate. Now, a lot of lenders might use 5%, even though throughout Los Angeles, the average vacancy rate is less than 5% in some markets, in some micro markets. Lenders typically will use a 5% vacancy rate. So that's what we're going to use in this example. So our gross potential rent of $240, we're going to multiply that by a vacancy rate of 5%, which gives us a $12,000 vacancy amount. All right. So we take the $240 less the 12. That's going to equal $228,000, and that is what is known as our EGI, or our effective gross income. Okay. From that, we're going to subtract some operating expenses. Now, for the sake of argument, I've got insurance, there might be some gardening, there's likely going to be some maintenance on the property, some wear and tear, some maintenance. In this particular example, we're paying for the water for the property. There are some ways of changing that, but in our example, I'm imputing some water, and there's likely going to be some other expenses along the way. So for the sake of argument, I've just simply imputed a 30% operating ratio, okay? So 30% of our 228 is going to equal our operating expenses of $68,400. It might be less, it might be more, but for the sake of our example, it's about 30% operating ratio, which equals $68,400, okay? Now, we take this $68,400 and we subtract that from our EGI of 228, okay? So 240 gross potential rent less our vacancy equals 228. Less our operating expenses equals our NOI, or our net operating income. That equals 159.6, okay? So we have 240 less vacancy less OpEx is 159.6. Now, the formula for a cap rate is our net operating income divided by this particular purchase price. We're going to assume that the purchase price is the market value. That may or may not be the case, but in our example, we're going to assume that. So our net operating income of 159.6 divided by our purchase price of 3.5 million equals a cap rate of 4.56%. Now, what does that mean? That means that if I were to write a check for $3.5 million, at the end of the year, at the end of our 12-month hold period, we're going to have 159.6 left over from this 240 in rent. Okay? So if I wrote a check for $3.5 million, I would yield a 4.56% cap rate on that $3.5 million purchase. Okay? That's what a cap rate is. It's an unleveraged return. I write a check for the $3.5 million. At the end of the year, I'm going to yield a 4.56% cap rate. Okay? That's what a cap rate is. Now let's take this one step further. What I've done here is I've just assigned a variety of cap rates to determine what would be my purchase price if I wanted to target a particular cap rate. Okay? This is often what buyer investors do when they want to purchase a property. So we've determined that this cap rate existing is at 4.56. If a buyer wanted to only pay, or yield rather, a 6% cap rate, they would only pay $2.66 million for the property. Okay, let's take a look at that one more time. The existing cap rate is a 4.56. If a buyer said, Mark, I only want to, or my target is I want to yield a 6 cap, they would then only pay $2.66 million for the property, about $1 million less than its current value. Okay. If the buyer said, Mark, I want to target a 10 cap, they would only pay 1.59 or about 1.6 million for the property. Now, if you can find an opportunity to yield a 10 cap in Los Angeles on a 10-unit apartment property at stabilized rents, would you please call me? Because I think I might want to buy that with you or buy it from you. Okay, so let's take a look here. We're riffing simply on this cap rate. If the buyer said, I wanted to yield a 5 cap, they would only pay 3.192. So as you can see here from these targeted cap rates, there is an inverse relationship between cap rate and value. In other words, the higher the cap rate, the lower the value. The lower the value, the higher the cap rate. Okay? The higher the cap, the lower the value. The lower the value, the higher the cap. There's this inverse relationship between cap rate and value. Okay? That, in a nutshell, is the nature of a cap rate. So let's summarize. The cap rate represents the net operating income divided by the value, and the cap rate essentially is an unleveraged return, meaning that if I were to pay all cash for the opportunity, at the end of that year, at the end of that 12-year hold period, my cap rate would be my yield on that all cash purchase. Okay? Once again, my name is Mark Ruff. If you'd like to discuss the nature of cap rates, if you'd like to take a look at analyzing a property to purchase, or if you'd like to discuss perhaps selling an investment property that you presently have or exchanging it into another opportunity, my contact information is below. You can email me here, or you can pick up the phone and contact me the old-fashioned way by calling me. Again, my name is Mark Ruff. I'm hopeful that this information is helpful to you.